now to talk business, thanks to our partners Forsyth Barr. Quite a flurry of half-year results posted, so let's tick them off this morning. Garth Bray, host of Herald Now Business, is with us back at the desk. Garth, good morning.
Good morning, Ryan.
Let's kick off with Mercury.
Yeah, right. Obviously, it's a big player in the market, and I know you were talking to Genesis earlier today, but look, so they've posted a EBITDA of 537 million for the half year. That's up 28% on the half year of 25. So obviously the lakes are full, she's been raining, do quite well. Wee bit of expectation that there might have been an uplift in full year guidance, but they're saying that that remains on track. So we'll just sort of see how that plays out once people digest the full results, whether they sort of like that or think, oh, you know, could have done better. Looking further down, we've got PGG Wrightson, obviously, which is a big rural provider, and they've announced a positive half-year result, as they say, with operating revenue 619 million, up 49.1 million, or 9%. So I guess you're just saying basically great execution in a pretty supportive market at the moment, pretty favourable commodity prices as well, just really doing well for them in some pretty key segments as well. So, you know, red meat, I think, is the story behind that.
Yeah, 100%. Now, what about Vulcan Steel?
Yeah, look, they've struggled a wee bit, it's fair to say. I guess, you know, pretty closely tied to construction and so on. They've just completed some purchases there, I think, in roofing industries. But they are saying basically, look, it's the economic climate remains difficult across New Zealand and Australia. Earlier indications suggest that the overall market's stabilised and entering a sort of a recovery phase, which is the kind of talk that you like to hear. So they were reporting EBITDA of 56.3 million, down 1.1% for the previous comparable period. So still a wee bit of work for them to do in the second half, as
all right.
Hopefully construction.
We have had a load this morning. We've got property for industry and NZME to get through. Property for industry, how do they look?
Yeah, not bad. They're obviously a big commercial landlord, $2 billion portfolio, but heavily in industrial and commercial, so market demand's been a wee bit soft in some of those areas. Nonetheless, they did some revaluations on about 19 of their properties, fair value gain of those of 3.2%, so basically the value of their stock increasing there, and I think overall reporting, they've got a range of different measures that you want. Interim results of profit after tax of 46.9, up 18.2 million, so doing all right there. And last of all,
but not least,
NZME. How do you want to say that one? I guess, look, a lot of interest in the cost out program that's been going on there. That I guess that we've sort of seen about, I think, a $12 or $13 million impact on that in the coming quarter. And, oh, crikey, the computer's just crashed, which is probably not a great sign there. Look,
maybe that's part of the cost out program.
Click OK and we'll be OK. Yeah, look, effectively, statutory impact of 13.3 million and EBITDA of 62.3, up 15%. So earnings up, I guess, largely driven by the fact that there was some cost reductions and also some interesting revenue growth there for One Roof, which will be one that the market watches pretty closely.